Hello, this is Nick Paulson with the FarmDoc team bringing you this 5-minute FarmDoc focused on the 2026 crop insurance decisions. The crop insurance price discovery period has concluded for crops with a sales closing date of March 15th, and final projected prices and volatility factors have been released by USDA's Risk Management Agency. The projected prices for corn and soybeans are determined each year during the month of February for most U.S. counties that grow corn and soybeans, including Illinois. Specifically, futures contract settlement prices for the December corn contract and the November soybean contract, often referred to as the harvest contracts for both crops, are averaged across all active trading days during the month of February. Projected prices have a direct impact on insurance guarantees and the premiums paid for federal crop insurance policies. Higher projected prices result in larger insurance guarantees and, as a result, higher premium costs, holding other factors constant. The impact of projected price levels on guarantee and premium levels apply to both revenue and yield insurance programs. Volatility factors are a measure of the potential variability in prices that could occur during the insurance period. These are based on measures of implied volatility from the options markets for each crop. These implied volatilities are measured and averaged over the final 5 trading days during the February price discovery period for corn and soybeans. Higher volatility factors suggest larger potential price deviations from what the market currently expects, resulting in higher crop insurance premiums for revenue products. Lower volatilities suggest market expectations for less price variability and thus lower premiums. For corn, the settlement price for the December 2026 corn contract averaged $4.62 per bushel over the month of February. This is 8 cents below the 2025 projected price of $4.70 and 14 cents below the average projected price for corn since 2011 of $4.76. Holding other factors constant, the lower projected price translates to slightly lower insurance guarantees and lower premium costs for the same policy and coverage level in 2026 compared with last year. The volatility factor for corn in 2026 is 0.15, down from a value of 0.18 in 2025. The lower volatility factor will contribute to lower insurance premiums for revenue products this year. In fact, the 0.15 volatility factor matches the lowest value observed over the past 15 years for corn. For soybeans, the settlement price for the November 2026 soybean contract averaged $11.09 per bushel over the month of February. This price is 55 cents higher than the 2025 projected price of $10.54 per bushel, but 23 cents per bushel below the average projected price for soybeans since 2011 of $11.32. The higher projected price will translate into larger insurance guarantees being available in 2026 compared to 2025. The volatility factor for soybeans this year is 0.13, down from 0.14 in 2025. This is the lowest volatility factor for soybeans since the 2023 crop year and only slightly higher than the lowest value of 0.12 over the past 15 years. The lower volatility factor will tend to reduce premium costs for equivalent revenue policies compared with years with higher volatility factors, assuming other premium pricing factors are the same. In addition to the final projected prices and volatility factors, producers should also be aware of some significant changes to crop insurance for 2026. Subsidy rates have been slightly increased for some coverage levels for the commonly used farm-level policies that are part of the combo product. These include revenue protection with the harvest price exclusion, and yield protection. Substantial increases to the subsidy rates for the supplemental and enhanced coverage option policies also take effect in 2026. These changes will result in producers having access to coverage at lower costs compared with previous years. We are recommending producers take a serious look at the supplemental area products in 2026. While farm-level experience will not always align with what occurs at the county, the 80% subsidy rate for SCO and ECO make them much more attractive than in previous years. We suggest first prioritizing the use of ECO at the 95% coverage level. Then consider SCO for additional coverage, particularly if you consider reducing the coverage level of your underlying farm-level plan. Our analysis suggests that the use of ECO and SCO can substantially increase the expected return to your insurance coverage portfolio and increase the downside risk reduction achieved, all at similar or lower premium costs than what the farmer would pay for a higher coverage level RP plan on its own. The final projected prices and volatility factors are now built into the various crop insurance decision tools available from FarmDoc, with links to these resources provided in the video description. We also urge readers to review the FarmDoc Daily articles linked in the description. These articles have been focused on 2026 crop insurance decisions over the past month and a half, particularly the use of SCO and ECO, given the substantial increase in subsidy rates for those products. Thanks for tuning in to this 5-minute FarmDoc. Please consider subscribing to our channel to make sure you are updated when the FarmDoc team releases new videos covering topics of interest to the agricultural community.